Canadians are navigating higher interest rates and hopeful that hawkish action from our Bank of Canada will U-turn at some point. But while household debt gets a lot of attention, individuals are not the only borrowers. The government itself has borrowed in a big way. And our next guest says some adjustments to the federal government's budget planning could be necessary if rates stay higher for longer. David Dodge is a senior advisor at Bennett Jones and the former governor of the Bank of Canada. He joins us now from Ottawa. David, nice to see you.
Good to be with you.
You're someone who is well-versed not just in monetary policy, but in fiscal planning as well. What have you been observing, at least in terms of budget planning in Ottawa, given this rapid increase in interest rates?
Well, they're going to have to plan for a higher debt service cost than the minister planned in her budget. That means that there's going to be less room for government to do other things.
And is this a matter of, as part of that budget planning, making assumptions around where interest rates could be that at this point might seem a little misguided?
Yeah, I think basically economists and the market have been overly optimistic about where interest rates and the real rate of interest is going to settle out once we work through the last couple of years of adjustment from COVID. The basic assumption that a lot of people make is that we're going to go back to pre-COVID times when the real rate of interest, that is after inflation, was almost zero. There's a view that most people hope, at least, think that that will be the case again. And that's just wrong. It will not be the case again. There are all sorts of factors that are going to push up pressures on inflation going forward, which means the central banks are going to have to be tighter than they were in the pre-COVID period, number one. And number two, that real rates are going to be higher because we're going to enter into a period of much stronger investment than we had in that earlier post great financial crisis period. And at the same time, the baby boomers are now moving into their saving years. They're no longer in their savings years. And so for all those reasons, we're going to see higher real interest rates. And if we get inflation back to 2 or 2.5%, and get expectations back to 2.5%, that probably means a so-called neutral rate of interest for the central bank is going to be somewhere between 3 and 4%, no longer between 2 and 3% as it was pre-COVID.
For individual Canadians who are navigating debt loads right now, they might look at what they feel like is their spending power or the money that they are generating to justify how they might navigate through higher interest rates. In Ottawa, when it comes to budget planning, we often hear about Canada's debt to GDP ratio as one of the reasons why we were in a position to continue with some pretty ambitious spending, even as we started to enter this new interest rate era. How does that math work out now that interest rates have climbed as quickly as they have?
So the math works out this way, that over the medium term, rather than the budget assumption that debt service costs for the government would be roughly 9% of their revenues, it's going to be somewhere around 10.5 or 11% of their revenues. And that's kind of the minimum amount. And that's assuming that they strictly stick to their spending plans, which I think is going to be extraordinarily difficult for them to do, given the pressures that they're under on all sorts of fronts, both in terms of income distribution and in terms, most importantly, of the investments that governments themselves have to make.
Now, David, you've outlined a lot of things to think about, and certainly from the spending side in Ottawa. But for Canadians who have watched these higher interest rates and now hear about cooling effects on the economy and are wondering if, at the very least, we might see some reduction in interest rates, if not this year, then maybe next year, what should we be thinking about if you start to see that slowdown impact? And some would argue we are already seeing it.
Yeah. Well, we need to slow a little bit because at the moment we still are generating excess demand in the economy. So we need demand to slow a little bit, or somehow magically everybody become more productive, which we've had difficulty achieving over many years. So what should they be thinking? Well, they should be thinking that sometime at the end of 24 or maybe early 25, rates will come down a bit from the 5%, the central bank rate at the moment, to something probably in order of 3.5%. So, some improvement in the mortgage interest that they will be paying compared to right now, those people that are on pay-as-you-go, if you will, for their mortgages. So a little bit of improvement, but we're not going back. We're not going back to the 2% interest rate at the Bank of Canada that we enjoyed in the 10 years leading up to COVID. And we're certainly not going back to the 1.5%, 1 or 1.5% that we had as recently as 2021. Wow. So people got to be prepared for that. And the question will be, are they going to have higher income? Yes. But in essence, the changes that are taking place in the world mean that households in aggregate, just as businesses in aggregate, are going to have to devote more of their income, more of their earnings, to investment in the future, and that going to leave less, a smaller share over for current consumption. And that's the facts that we've got to face. That's the world that we're facing as we go through the next decade or so.